Your money sitting in a bank savings account is losing 3 to 4% of its value every year to inflation. You think you're being safe? You're actually being robbed. Legally. Quietly. And most people have no idea it's happening. Here's the painful truth. $100,000 in your savings account today will have the purchasing power of $85,000 in 5 years. You didn't spend a dime. Inflation just ate $15,000 while you were playing it safe. Meanwhile, wealthy people, they don't keep cash in banks. They park money in 5 specific assets, safer than the stock market, more profitable than any savings account, and most are literally backed by the US government. I'm about to show you all 5. Asset number 5 protects you against everything. Market crashes, inflation, even currency collapse. And most people don't own a single ounce of it. If you're tired of losing money by doing the safe thing, hit subscribe and comment on how much you have sitting in regular savings right now. No judgment, just awareness. Or drop losing value if you just realized your cash is shrinking. Let me show you the first asset that's government-backed but pays 10 times what your bank does. Asset 1. Treasury bills and money market funds. Let me ask you something. What's your bank paying you in interest right now? 0.5%? Maybe 1% if you found some high-yield savings account they're advertising like it's a lottery jackpot? Congratulations, you're earning $500 a year on a $100,000 account while inflation steals $3,000. You're net negative $2,500 annually. That's not saving. That's slow-motion financial suicide with a friendly bank teller smiling at you the whole time. Here's what makes this even more insulting. The government will pay you 5% on that same money with the exact same safety level. Actually, safer than your bank. Because your bank can fail. The US government? It would print money before it defaults. There's a parable in the Bible about a servant who buried his money in the ground instead of investing it. His master called him wicked and lazy, took everything away, and gave it to someone who actually made their money work. The lesson isn't take risks. It's doing nothing with money is losing money. Preservation isn't safety when inflation exists. Growth is safety. Warren Buffett said in 2022, the worst investment you can have is cash. Not because cash is evil, because inflation destroys it silently. Look at history. $10,000 in 1980 is still $10,000 today, but its purchasing power? $3,200. You lost 68% by playing it safe for 40 years. So here's what wealthy people do instead. Treasury bills and money market funds. T-bills are short-term loans to the US government. You're literally lending money to the Treasury. They pay you back in 4 weeks, 8 weeks, 13 weeks, 26 weeks, or 52 weeks. You pick. Current rates: 4.5 to 5.5%. That's 10 times what your bank pays. Same safety. Actually better safety because it's backed by the full faith and credit of the US government. Money market funds are just pools of T-bills and short-term government securities. You buy into the fund, they handle everything, and you get paid monthly. Currently paying 4.8 to 5.2%. Still liquid. Access your money in 1 to 2 days. Many are FDIC insured up to $250,000 or government backed. Let me show you the math that should make you physically angry at your bank. $100,000 in a savings account at 0.5% equals $500 a year. $100,000 in T-bills at 5% equals $5,000 a year. Same money, same safety. Difference? $4,500 annually. Over 10 years, that's $45,000 you left on the table by being safe in the wrong place. $45,000 your bank profited from by paying you nothing while they lent your money at 6% to someone else. Here's your move this week. Not next month, this week. Open an account at treasurydirect.gov to buy T-bills directly from the government. Or open a money market fund at Vanguard or Fidelity, funds like VUSXX or SPACX. Move 50% of your savings there immediately. Keep 3 to 6 months of expenses in your regular bank for emergencies and convenience. The rest, put it to work. There's a retired couple I know who had $200,000 sitting in a bank savings account, earning $1,000 a year while losing $6,000 annually to inflation. Net loss, $5,000 every year. Their financial advisor finally asked, "Why are you volunteering to lose $5,000 annually?" They moved it to T-bills, paying 5%. Now earning $10,000 a year, 10 times more, with the exact same safety. Over 10 years, that decision will put an extra $90,000 in their pocket. Same money, same safety. They just stopped letting their bank rob them. They told me, "We thought we were being responsible by keeping cash in the bank. Turns out we were just being ignorant." Moving to T-bills didn't require courage, just 10 minutes and a decision to stop losing. Cash sitting in a bank isn't safe. It's dying slowly while your bank profits. T-bills and money market funds are safer because they actually protect your purchasing power while being government-backed. Safety isn't about avoiding all risk, it's about preserving what you have. But T-bills have one problem. They pay you today's rate, but don't protect against future inflation. Here's the asset that does. Asset 2, inflation-proof government securities. Because here's the problem with T-bills. They're paying you 5% today. Great. But what happens when inflation decides to throw a party and spike to 7, 8, or 9%, as it did in 2022? Now your 5% T-bill is losing you money again. You're back to getting robbed, just slower. You need protection that doesn't just pay you a fixed rate. You need something that adjusts automatically when inflation goes crazy. Something that says, inflation jumped to 9%? Cool, now I'm paying you 9% too. Most people have no idea this exists. And the government sure isn't advertising it because, well, they'd rather pay you nothing while borrowing your money cheaply. But it's real. It's available to everyone. And wealthy people max it out every single year without fail. They're called I-bonds, U.S. savings bonds that are indexed to inflation. Let me show you what happened in 2022 when inflation hit 9.1%. And everyone was losing their minds. People with money in regular savings accounts lost 9% of purchasing power. People in T-bills paying 4% lost 5% of purchasing power. People in I-bonds, protected. Their bonds automatically adjusted up to 9.6%. They didn't just survive inflation, they beat it. I-bonds have two components. A fixed rate that stays the same for 30 years, currently around 1.3%, plus the inflation rate that adjusts every 6 months based on CPI. When inflation was 9%, I-bonds paid 9.6. When inflation drops to 3%, they pay 4.3. Your principal is always protected because the rate moves with inflation, not against it. Here's historical proof this matters. Someone bought $10,000 in I-bonds back in 2000. 24 years later, those bonds are worth $21,800, fully adjusted for every inflation spike along the way. Meanwhile, $10,000 sitting in a bank savings account, worth maybe $6,400 in purchasing power. Difference? $15,400 just from inflation protection. Now here's the catch. Because of course there's a catch. The government limits you to $10,000 per person per year. $20,000 if you're married. You can't just dump $500,000 into I-bonds tomorrow. It's a slow build. But that's exactly why you need to start now. Here's how it works. You buy at treasurydirect.gov. Minimum $25, maximum $10,000 annually. You must hold for 1 year. It's completely locked. Can't touch it. If you cash out before 5 years, you lose the last 3 months of interest. That's it. Not principal, just 3 months of interest. After 5 years, zero penalty, full liquidity, access whenever you want. Current rate as of late 2024, around 5.27%. And it adjusts every May and November based on inflation data. Here's your I-bond ladder strategy. Buy the maximum every January for 5 years straight. Year 1, $10,000. Year 2, another $10,000. Year 3, 4, 5, same thing. After 5 years, you've got 50 to 100,000 if married, sitting there, inflation protected, and now your year one bonds are accessible with no penalty. You've created rolling liquidity with permanent inflation protection. There's a teacher I know, 45 years old, terrified about retirement because she knows her pension won't keep up with inflation. Started buying 10,000 in I bonds every year starting in 2018. By 2024, she had 60,000 in I bonds. When 2022 hit and inflation spiked to 9%, her friends and savings accounts were panicking. Her I bonds adjusted to 9.6% while everything around her was chaos. She told me, I bonds aren't sexy. They're not exciting. I'm not getting rich off them. But I sleep at night knowing that no matter what inflation does, 3%, 6%, 10%, my money adjusts with it. That peace of mind is worth more to me than chasing returns and risking everything. I bonds are the only asset on earth that literally guarantees you won't lose purchasing power to inflation, backed by the US government. Wealthy people max these out every January like clockwork. Not because they're greedy, because they're not stupid. Now, those two assets are perfect for safety, but they have limits. What if you've got 200,000, 500,000, $1 million to park? Here's where the wealthy go for serious cash. Asset 3, the income machine. Because here's the problem you just ran into. T-bills are great, I-bonds are perfect for inflation protection, but they have limits. I-bonds cap you at 10,000 a year. T-bills are fine for any amount, but the process gets annoying if you're managing hundreds of thousands across ladders and maturities. So what do you do when you've got 200,000, 500,000, $1 million to park safely? You can't just dump it all in a savings account and watch inflation eat it. You need something scalable that pays a reliable income without the stock market roller coaster. Enter investment-grade corporate bonds. And before you panic thinking corporate means risky, let me explain what we're actually talking about here. Corporate bonds are just you lending money to a company instead of the government. They pay you interest for the privilege of borrowing your money. But here's the key. Not all companies are created equal. Junk bonds from sketchy companies, yeah, those are risky. Investment-grade bonds from Apple, Microsoft, and Johnson & Johnson, those are safer than most banks you're keeping your money in right now. These companies have AAA and A credit ratings. They have tens of billions in cash. They're not going anywhere. And here's the kicker. If a company does fail, bondholders get paid before stockholders. You're first in line. Stock investors? They get whatever's left after you take your cut, which is usually nothing. Warren Buffett's Berkshire Hathaway owns billions in corporate bonds. Not stocks, bonds. Why would one of the greatest investors alive park billions in bonds? Because when you have serious money, safety, and a reliable income, excitement beats every single time. Now, you're probably not buying individual corporate bonds unless you've got 500,000 plus to properly diversify. But that's fine. Bond funds exist for exactly this reason. You buy one fund, you instantly own pieces of 1,000 different corporate bonds. Maximum diversification, minimum hassle. Investment-grade corporate bond funds are currently paying 5 to 5.5%. Vanguard Total Bond Market, ticker BND, pays around 4.5 to 5% and holds over 10,000 bonds. iShares Investment-Grade Corporate Bond, ticker LQD, pays 5 to 5.5%, focused on the highest-rated companies. You're getting paid monthly, it's liquid, sell any day the market's open, and the risk is minimal because you're diversified across hundreds of massive, stable companies. Let's compare the safety ladder. Savings account at 0.5%, technically safe but guaranteed loss to inflation. T-bills at 5%, zero default risk, government-backed. I-bonds at 5+%, zero risk, inflation protected. Investment-grade bond funds at 5 to 5.5%, minimal risk, massively diversified, scalable to millions, fully liquid. Here's your move this quarter. Open a brokerage account at Vanguard, Fidelity, or Schwab if you don't have one. Buy shares of BND or LQD. This is for cash you won't need for 1 to 3 years, but you want working harder than a bank account. Set dividends to reinvest automatically so your income compounds. There's a business owner I know who sold his company for $800,000. He was terrified of the stock market, too volatile, too risky for money he might need. But he also wasn't stupid enough to let it rot in a bank account, earning basically nothing. His financial advisor suggested investment-grade bond funds. He put the full $800,000 in. Now he's earning $42,000 a year, 5.25% yield, versus the $4,000 he'd get in a savings account. That's $38,000 extra annually. Same safety profile, same liquidity, just a smarter parking spot. He told me, "I sleep great at night knowing my money's not in the stock market casino, but it's also not dying in a bank. It's working, making real income, and if I need it tomorrow, I can sell and have cash in 2 days." That's the perfect middle ground for serious money. Investment-grade corporate bonds aren't sexy. They're not going to double in a year. But that's not the point. The point is parking large amounts of cash safely while earning actual income that beats inflation. Boring wins when you've got real money to protect. But bonds have one weakness most people don't understand: interest rate risk. When rates rise, bond values drop. Here's the asset that doesn't care about interest rates at all. Asset 4. The inflation-beating cash flow. Because here's the weakness with bonds that nobody tells you until you learn it the hard way. When interest rates go up, your bond values go down. It's called interest rate risk, and it's the hidden tax on bond investors. Here's how it works. You buy a bond paying 5%. Great. Then interest rates jump to 7%. Now nobody wants your 5% bond because they can get 7% elsewhere. So if you need to sell before maturity, you're selling at a loss. You're stuck choosing between holding to maturity or taking a haircut. So you need an asset that gives you reliable income like bonds, but grows that income over time instead of staying fixed. Something that beats inflation not just by keeping pace, but by actually increasing what it pays you every single year. Enter dividend aristocrats. And yes, that's the actual name. These are companies that have increased their dividend payouts for 25 consecutive years or more. Not just paid dividends, increased them every single year for decades. We're talking about Coca-Cola, which has raised dividends for 62 straight years. Johnson & Johnson, 61 years. Procter & Gamble, 67 years. These aren't risky startups, they're massive, boring companies that sell soap, bandages, and soda. And they print money so consistently that they raise what they pay shareholders annually, usually faster than inflation. Here's the math that makes bonds look silly. You invest $100,000 in a bond, paying 5%. Year 1, you get $5,000. Year 10, you get $5,000. Year 20, you get $5,000. Fixed forever. Meanwhile, inflation ate 30 to 40% of that income's purchasing power. Now the same $100,000 in the dividend aristocrats. Year 1, a 3% yield equals $3,000. Seems lower than the bond, right? But watch what happens. These dividends grow an average of 6% annually. Year 10, you're receiving $5,400. Year 20, $11,700. Year 30, $25,000 annually. That's a 25% yield on your original investment. And that's just the income. The stock value usually appreciates too. So you're getting growing income plus capital appreciation. Bonds give you neither. Warren Buffett's been screaming this from the rooftops for decades. The best protection against inflation is your own earning power. Second best is owning excellent companies. Dividend aristocrats are excellent companies. They've proven it by raising dividends through recessions, wars, pandemics, and every crisis for 30+ years. Here's your strategy. Buy the Noble ETF, ticker NOBL, which is an index fund holding all 67 dividend aristocrats, instant diversification. Or pick 5 to 10 individual aristocrats, Johnson & Johnson, Procter & Gamble, Coca-Cola, 3M, Caterpillar, Lowe's. Current yields range from 2 to 4%, but remember that yield grows. Set all dividends to reinvest automatically for the first 10 years. Let those dividends buy more shares, which pay more dividends, which buy more shares. Compounding in action. After 10 years, switch to taking the dividend income as cash. Now you've got a growing paycheck that increases annually without you doing anything. This is for money you don't need to touch for 5+ years, because stock prices fluctuate short term. But here's the beautiful part. You don't care about the stock price because you're never selling. You're living off the dividends. Stock drops 30%? Who cares? Your dividend check still shows up, and it's probably bigger than last year's. There are a couple I know, both 50 years old in 2014, who wanted retirement income they could count on. They put $300,000 into Dividend Aristocrats. Year 1, they received $9,000 in dividends, a 3% yield. Seemed modest compared to bonds paying 5% at the time. Fast forward to 2024. They're now receiving $16,200 annually. That's a 5.4% yield on their original investment. And the stock value grew to $580,000. Total gain, $280,000 in value, plus a dividend stream that grows every year. They told me, we're not selling a single share, ever. We're living off dividends that increase faster than inflation while our principal keeps growing. Our income goes up every year while we literally do nothing. That's the entire point of money, making it work so we don't have to. Dividend Aristocrats aren't about getting rich quickly. They're about income that grows faster than inflation forever. Wealthy people think in decades, not days. This is a decade-plus play. Now here's the final asset, the one that protects you when everything else fails. Market crash, inflation explosion, currency collapse, banking crisis. This asset has survived them all for 5,000 years. Asset 5, physical gold and precious metals. Now here's the final asset, and this one's different because everything we've discussed so far depends on one assumption: that the financial system keeps functioning normally. Banks stay open. The government honors its debts. The dollar maintains a reasonable value. Markets operate smoothly. But what if they don't? What if banks fail like 2008? But worse. What if government debt spirals so out of control that the dollar crashes? What if we hit a scenario where your T-bills, bonds, and dividend stocks are all denominated in a currency that's collapsing? You need an asset that exists outside the financial system. Something that doesn't require banks, governments, or anyone's promise to have value. Something that's been money for 5,000 years and has survived every empire, every currency, every crisis. That's gold and silver and platinum. Physical precious metals you can hold in your hand. Now, before you roll your eyes thinking I've gone full doomsday prepper, I haven't. This isn't about hiding in a bunker with canned beans. This is about what every wealthy family on Earth has done for generations. Hold 5 to 10% of wealth in physical gold as insurance against catastrophic scenarios. Here's what nobody tells you. Gold doesn't go up. Currencies go down. In 1971, gold was $35 an ounce. Today it's over $2,000. Gold didn't change. The dollar lost 98% of its value. Every paper currency in history, 100% of them, has eventually failed. The dollar's been losing purchasing power since 1913. Gold's been gold for 5,000 years. Ray Dalio, billionaire investor who studied 500 years of economic history, said it perfectly. If you don't own gold, you know neither history nor economics. That's not from a gold bug. That's from a guy managing $150 billion who's seen every pattern repeat. Wealthy families don't hold gold to get rich. They hold it as insurance. Like home insurance. You hope you never need it. You're grateful as hell if you do. Here's how to own it. Physical is best for true insurance. Buy bullion coins, American Gold Eagles, Canadian Maple Leafs from reputable dealers. 1-ounce gold coins, silver coins, whatever fits your budget. Store them in a home safe if it's a small amount, or use a vault service like Brinks or Delaware Depository for larger holdings. If physical feels too complicated, there are ETFs, GLD for gold, SLV for silver, PPLT for platinum. They track the price almost perfectly, and you can sell instantly. You don't truly own the metal, but you get the price protection, and it's completely liquid. Your allocation, 5 to 10% of investable assets. Not 50%, that's paranoia. But not zero, that's ignorance. If you've got 100,000 invested, hold 5 to 10,000 in gold or silver. Rebalance annually. If gold spikes to 15% of your portfolio, sell the excess. If it drops to 3%, buy more. This isn't about profit. It's insurance against the financial system doing what financial systems have always eventually done throughout history. Fail. There's an investor I know who had a $500,000 portfolio in 2008. 90% stocks and bonds, 10% physical gold, $50,000 worth. When the crash hit, his stocks dropped 50%, bonds got shaky, and panic was everywhere. His gold? UP 25%. Suddenly worth $62,500. He didn't sell the gold, that wasn't the point. But the psychological comfort of watching one asset go up while everything else burned? Priceless. It kept him from panic selling stocks at the bottom. By 2024, his stocks recovered and then some, and his gold position is now worth $130,000 without him doing anything. He told me, "Gold is the most boring investment I own until everything else is terrifying. Then it's the only thing that makes sense. I sleep better knowing 10% of my wealth exists completely outside the banking system. If banks fail, governments collapse, currencies crash, I've got something real." Gold isn't about getting rich. It's about staying rich when everything else fails. Wealthy families have passed down gold for generations for one simple reason. It survives when currencies don't. All of the above will be meaningless if you don't actually move your money out of that bank account. So there they are. 5 safer assets wealthy people use instead of letting cash die in banks. T-bills and money market funds paying 5%, government-backed and liquid. I bonds that adjust with inflation automatically. Investment-grade corporate bonds for scalable, reliable income. Dividend aristocrats with income that grows every year. And physical gold as insurance when everything else fails. Your cash is losing value every single day it sits in a savings account. You're not being safe, you're being robbed by inflation while your bank profits. This week, move 50% of savings to T-bills or a money market fund. This month, max out I-bonds at 10,000. This quarter, start one position in dividend aristocrats or bonds. This year, buy some physical gold. Don't do everything, just start with one. Hit subscribe if this woke you up. Comment on which asset you're starting with: T-bills, I-bonds, bonds, dividends, or gold. Drop how much you have sitting in savings losing value. Awareness is step 1. Your money is dying. Move it. Protect it. Wealthy people figured this out decades ago. Now you have to.